Good evening and welcome to another edition of the ShadowTrader Video Weekly for Sunday, January 24th, 2021. Had to check my blotter for a second there. So let's begin with a rewind of where we were last week. If you recall, the title of last week's video was some slightly bearish signals. And none of those actually came to light this week. We had a shortened trading week. Monday was a holiday. And in the last 4 trading days, the market rallied pretty hard off of that 20-period moving average that I talked about last week. So none of the slightly bearish signals that I talked about actually bore any fruit for sellers. This is absolutely just fine with me. Those of you who are following me in the weekly options advisory, and there are a lot more of you this week because many of you came on board after the free trial, so I thank you for that. It's great to have all you. Those of you that are watching this that are part of the advisory know that we didn't have anything short on anyway. So it's really, no harm, no foul. I didn't have any long puts. I didn't have any short stocks. So, it doesn't really matter. But I did feel that those were some things that needed to be mentioned because they were happening technically as nuanced as they were. But the market, there was no follow through to the downside because of it. And that's also why when I made the video, I was very sure to put in that word slightly bearish signals rather than, big bearish signals or, this market's crashing or something ridiculous like that. Anyway, that being said, let's take a look at the technicals here, starting with the S&P, and then we'll get into some other stuff that I think you'll enjoy very much. The bounce off the 20 was here. We're a little bit overextended off the 50, but not really much more than we've been. I like the price action here. Basically, we're coming into a really important earnings week next week. I've been alluding to this, that we've got Facebook, Apple, Tesla, Microsoft, all on the same day on the 27th on Wednesday. So potentially could be some fireworks. We're going to see how the market acts. But everything's just looking pretty strong here. I mean, I have to say this pullback over the last couple of sessions is really minor. Whatever little downside there was on Friday was mostly due to a liquidation break at the end of the day in the last 15 minutes. Classic liquidation break. I mean, that's just basically short-term traders just getting out before the weekend, really kind of meaningless. I'll show you that in more detail when we get into the market profile, okay? But before we do, let's just take a little trip through a couple other majors. I want to show you NDX here, which looks fantastic. I mean, it was just a nice move out of the consolidation. This is really kind of a long-term congestion here, and we've just started to break out of it, so there's no reason why that cannot go higher. And last but not least, let's take a look at the RUT, which had a little bit of choppy action this week with some pullbacks, but again, also short-lived, as is everything. RUT is still well above the 20, and it just looks good here. It's more of kind of a congestion, like slow grind to the upside, so I don't see any reason why that can't keep going. I mean, notice how this was going much longer and was even actually, I think, a bit steeper than this one. I look at the sort of slope of these rallies a lot, which I think gives you a little bit of information as well. All right, let's take a quick look at the profile. There's a couple of nuances I want to point out that are important. We had a classic, and I do mean classic, it doesn't get any better than this one, poor high on Thursday. If anybody doesn't know, this is a poor high. It's something you should pay attention to very, very closely. When things like, because when things like this happen, there's opportunity to short. And just as this poor high is being put together in M period here, like right literally as it's happening, understand that I'm sending alerts out to people's phones with actual pictures of this, which is really cool. That's the beauty of the new Pro Trading Room software that we have for the weekly options. Is I'm not just sending text messages, I'm sending pictures with text, and you can get that like right to your phone, which is fantastic. So over the course of the day, I'll send out tons of little charts here and there, like at key moments when I see inflection points or things that are important. And I was alerting the subscribers to the fact that the poor high was developing at the moment, and you can see the market peeled off from there substantially down to the settlement here. And then the overnight session was even weaker on Thursday, between Thursday and Friday. As you can see, the overnight low was all the way down here. We actually went back into the 6-day balance area. So this is kind of important. So these poor highs are important. They're really good short-term signals to note. Basically, it's when there's no excess on the top. So for instance, this is not a poor high. This is an excess high. Poor high is one that has like a flat top, right? We've talked about that before. And basically, what does it tell you? It tells you that short-term traders are trapped at poor location and they're not getting anything for it because they didn't get that last push to get profit on their longs, and they've all been sort of crowding the plate. I like to call this crowding the plate because that's really what they're doing. They're all getting more and more long up at the top, and they're just sitting there, and then they have to liquidate. And the market was maybe slightly short-term overbought as well at the moment, so you got a little bit of liquidation there. As far as the Friday was concerned, as I was saying, we were looking fine near the high of the day on Friday, and then the last 15 minutes took us like to here to the settlement area. Again, I think it's a classic liquidation break, which doesn't mean much. I'm going to focus next week on whether or not the market can hold up over some of these key nuances here on the profile. Most importantly, you have the 6-day balance, which is this. This was a 6-day balance area. Obviously, you then had a look below and fail. Turn back up. When you turn back up into balance, the target is where? Target is to the opposing end of balance. And notice that since then we opened here. We broke. This is where we actually broke out of balance. Here's where we hit the target on this day. And then in terms of pullbacks back into balance, well, this overnight session doesn't really count for too much because we don't count those as much as we do RTH sessions. So here you had this little pullback, and notice where it pulled back right into the balance area high, but really kind of held it. So I think this is the key area to look at coming into next week, is that because if we do move a bit lower, then we've got this gap to deal with, which is still unfilled. This is a very large gap. And you're looking at about 37.07 to 38.11. So it's a decent sized gap here. 37.97, excuse me, I apologize. 37.07 to 3800 would not be possible. There wouldn't be a 100-point gap. 37.97 and 38.11, so you got 12 or 13 points here, and that could be in play. So there's a number of key levels that you want to pay close attention to next week. If you're not a subscriber to Peter's Pre-Market Perspective, although I really wish you all would be because it's so cheap, it's $1 a day, and it's, I think all of our stuff is some of the best value on the street for what I provide and for the amount we charged for all this stuff, which is really negligible. For $1 a day, you can have all these key levels every single day in your inbox at 9 a.m. sharp Eastern. And, I literally have hundreds of emails of all the people who just tell me what a big help it is to sort of plan out your day the right way, know where all the pitfalls may be, where the targets may be, what are the key turning points. And then, I always try to finish it with anywhere between 1 and 3 scenarios of how I think the day has potential to play out. So, all right, let's move in now to the meat of the video, so to speak, how to hedge ahead of earnings. This is probably why most of you are here, at least those of you who don't watch these videos regularly, who hopefully might be here, I should say, for the first time, because you may have found this on a YouTube search, or it might have come up on the right-hand side of your feed when you were looking at other trading videos, and that is fantastic. I love it when new people join the movement, so to speak. If you can, subscribe and hit the like button. That helps us as well. But how to hedge ahead of earnings. So first, a little bit of caveat. So we're going to talk about a real-life example here. And I purposely have this apple on, which is relatively sizable. It's not gigantic, but it's of decent size, of some consequence, where I would not want to just let it go and just kind of fall apart. You can see there's 7,000 shares long here. Currently, the profit's about 52,000. This basis is actually wrong. It's a long story, but I trade around these positions a lot and sometimes day trade back and forth. Doesn't matter all that much, but the actual basis of this is in the very low 132s. It's not 132.89. So I'm going to say it's closer to 132. So at 140, it's a solid $8 gain here, and obviously times the 7, you're talking about 55,000 or whatever. So I'm using this real life example purposely because this is something that is actually going to come into play for me next week, because I have to make a decision now as to whether or not I'm going to hold this through earnings. I generally am not the type of person who holds anything through earnings. One thing you have to keep in mind, I'm a very short-term trader. This position is only on because I've been experimenting with a number of different option strategies since around the beginning of the year, and I'm trading around this position all the time. Lots of different call and put structures on a weekly basis all around it. I'm not going to get into the details of that, but the core position, the underlying of it, which is the 7,000 shares Apple, that remains the same week after week. And as part of the strategy, although I don't want to call it that yet because it hasn't really crystallized into a real strategy yet that I could actually share with anybody, but over the course of the development of the position, it just kind of keeps getting added onto. So understand that. I'm just giving you a little bit of background of the color of how I ended up with 7,000 shares of Apple long. I did not buy them all at once at 132-ish because I thought that was a great price. They were accumulated all the way from 136 down to 128. So here we are with a basis of roughly 132. All right, let's take a look at the technical picture of Apple as we head into this earnings. And I think it looks fantastic. And for what it's worth, we're going to sort of work from the framework that Apple could easily be going much, much higher. And one of the reasons that I say that is because I always tell people that if you're going to short a prior high, make sure that a lot of time has elapsed between the short and when it was last there at the prior high. That is really important. When a lot of time has elapsed, like here, you almost always come up and back away. So this is a classic short area where short-term traders can short against that. Longs are taking profits as you get up to the high. And overall, what are you doing? You're forming the cup of a cup and handle. But when the time is short, and you can see here, this is less than a month, you don't short it. And you certainly don't short it when it's a third touch. So for those reasons, I think that Apple's actually going to go higher this week. Maybe the earnings is the catalyst, and maybe it just goes higher right before it. But regardless, I think it's a bit higher. So we're looking good into the earnings. And thus, a decision has to be made this week as to what to do with this position. Now, I'll be honest with you, I'm generally not the type of trader that likes to hold anything through earnings. I don't really do earnings plays. All the options trades that I do every week, which are myriad in number and in scope and in all sorts of esoteric spreads and whatnot, I don't do earnings plays. Earnings to me are a very 50-50 proposition. It's not good enough odds for me. Obviously, there is potential for enormous reward, but there is also potential for enormous loss. And I don't like that sort of risk-reward scenario, so it's not for me. So that being said, any further upside in Apple early in the week coming into Wednesday, let's say we can get it up to 141, 142, 143, whatever, would probably have me selling this position because I'd be looking at over $10 worth of gain on a sizable position that really didn't take all that long to hold, and I already made a lot of money on the options side selling around the position. So there's already tons of profit in this trade regardless. But if I was to be able to realize, say, $10 on the actual shares, and obviously because it's earnings week, I won't have any options plays around it, that would be just fine. But for the sake of this example, let's assume that we wanted to know what to do if we were going to hold the position. So let's take a look at that. So in order to take a look at that, we need to obviously get back to the chain. And I've already set up some examples here, some simulated trades of what are some of the different ways that we could hedge off the position. So the easiest thing to do right off the bat, and we're going to be looking at this 140 because this is is where the stock is now. We're going to assume that we were coming up to earnings and we were right at the 140. The easiest thing to do would be to buy the 140 put, which would give us full upside potential. Stock could gap up another $10 or whatever, but it would also give us full downside protection, 1-for-1. But because we're paying $5 of extrinsic value, it would also be very, very expensive. All right. Now, before we go any deeper than the simple just buy a put at the money, when we look at more esoteric spreads and things that are a little bit more complex, we have to also keep in mind this number here, which very simply tells us what is the plus minus what Apple can do over the next 7 calendar days, taking us into next week in either direction. And you can see right now that says plus minus $9.38. So for simplicity, let's call it $9. So that means that the options market is pricing in that at the end of next week, Apple is either going to be $9 higher or $9 lower. And that's good information to know because it helps us as far as where we might be able to be looking at different turning points in order to construct certain spreads to hedge off this position. So let's look at some stuff that might be a little bit more complicated on the put side. Instead of buying that put outright at the 140, we could buy a 140, 128, which is a $12 wide put for 427. Now, if we wanted to make this a little cheaper, we could just go $9 wide because we know that the potential is for it to only drop $9 if it does. That takes the price down to 372. The reason I said 128 and 129 is because that's in here. I like this area here right at the trend line. Notice that the trend line's coming in and the support right around 128. So that's an idea. You could have a vertical, which is 140, 128, or if you want to go a little higher, could be the 140, 131. That would ding you for $3.72. You would have limited downside protection, but you would have full upside gain. So not bad, okay? Now, if we want to get a little bit more creative with it, we can use these same strikes, roughly $10, and we can make a butterfly out of it, which is where we would put on this spread, and that brings the price down a little bit cheaper. Notice that now we're in the $3.10 level, and what type of protection does that get us? Well, it gets us full protection down to 130. So we've got $10 of protection to the downside, and it's only costing us $3. So notice that as we've brought some short puts into the mix, we've moved our cost of insurance down from $5 to $3.72 to $3.10, which is not bad. So it's getting a little bit better. Now, could we move the price down a little bit more if we did a broken wing? Broken wing butterfly is obviously when you have the same two strikes to start, but you put this strike a bit lower. You break that wing down lower. But in this case, because those out-of-the-money options are so cheap, you're not really saving much money. So it doesn't make sense to take on that extra downside risk for just 12 cents. That's important to note. If you're just going to gain 12 cents cheaper, don't bother with doing the broken wing. And what would happen also if we didn't do the lower strike at all and we just did a ratio spread, meaning that we just bought the 140 put, sold the 130 puts 2 times, where would that get us to? 292. But again, not really enough of a difference for that. Now, before we get into how to make this cheaper on the call side, I will tell you right now that my preferred way of looking at this would probably be to do the ratio. I'm pretty confident that Apple is not going to go down over $10. And notice that I'm getting a full dollar for these 130s. And because it's in a ratio spread structure, which means that it's +1 -2, I'm selling these 2 times, and I'm actually getting $200 per spread discount on my 140s. And that's the way you have to think about it. You're going into the trade with the assumption that Apple's not going down below 130, and you're only selling the 130s to get yourself a discount on the 140s, which you need. And notice that that brings the price just down just a little bit to 292. And like I said, it's not that much of a move down because from here, because the difference in these bottom strikes is not all that much, okay? But that being said, that's a structure that I really like, and if I wanted to be more aggressive, I could move this up to 131, brings it down to only 247. But remember, I have full upside gain, but what happens if there's a monster gap down below this area? Remember, what is the ratio spread actually made up of? It is made up of 1 long vertical and 1 extra short put. So I would pick up $10 of gain here to go against my long stock, go against the loss on my long stock there. But anything sub 130, I would be losing dollar for dollar. In this case, $7,000 a point for anything sub 130, right? Because we got contracts that are 7K or 7K in shares, which equals 70 contracts. And 70 contracts obviously is that times 100, which brings us back to our number of the shares that we have to protect. So we would be losing $7,000 per point for any price action below that 130 if we did the ratio. Now, if you are watching this and you have a position that you want to protect this way, just be very aware of the risks if there was to be some adverse, horrific gap down. Could happen. Out of this pattern, I don't really see it happening because I think this is a really bullish pattern, especially with this second touch. So we shall see. But the fact that I don't see it that way doesn't mean anything, doesn't mean that it can't happen, doesn't mean that it won't happen, et cetera, et cetera. So do not think that it can't happen. Now, if we can choose our put structure and we know what our risks are on the downside and we know how much protection we're going to get on the downside, whether it is full protection or partial protection, we can then obviously also be looking at the put side to offset some of that cost. So what if we took a single? The most obvious way would be to sell, and I don't actually want that one, I want this one. Let's go to 140. We could sell the 140 at the money and get $4. And that $4 covers almost any of the put strategies that we want to do. And what does that get us? It's important to understand. What does that get us? Well, we get partial protection on the downside or full protection if we want to just pay the $4.95 here. Do we get any upside participation in the gap? No, we get no upside participation in the gap whatsoever because we're cut off at the knees. Our stock will be called away for us at 140. We will protect the profit up to the 140. So the profit that you saw earlier on the screen of those 8 points or whatever that is, we would keep that, but we're not going to get any more than that. If the stock goes down, we lose profit in our shares, but at the same time, we would gain an equal amount on our long puts. Remember, we would own the 140 in all of these, so all the way down to 130, we would have a 1-to-1. So basically, it would be a push. So I like to tell people that if you're going to do it this way, it doesn't really make a whole lot of sense, and you might as well just sell your shares, because the only way that you're not going to sell your shares and work out perfectly is if Apple just stays at 140, but it's not going to do that, right? If it stays at 140, both sides go out worthless and you keep your stock, which would be great, but that's not going to happen. You would still have to kind of finagle it somehow, you know, and be closing these options, some of which potentially at a loss before the expiry in order for this to work out. It could still work out, but really only if you think that the price is probably going to hold steady and you want to hold the position would this make sense. If you think there's going to be a larger move in either direction, then it doesn't make a whole lot of sense to do it this way. So what does make sense? What I think makes most sense is to look at some sort of a call that is further out of the money. And in this case, I'll go back to the 149 that I had here because it is exactly $9 out of the money. And what kind of credit could I get for that? I would get $1.44. Now, obviously, does this cover any of these other structures fully? It does not. But if I was going to go in with the ratio of 140, 131, notice that I could get the price down to $1. It's 250 roughly minus 150. So I'm looking at a price of $1, which equals, in this case, because it would be 70 contracts, the insurance would cost me $7,000. But this would probably be worth it, because do you think Apple is going to, if it gaps up, do you think it's going to gap up more than $1? Probably. What if it gaps up 9? Well, you just made $8 of extra profit. In this case, it would double the profit on the trade from, $56,000 to way over 110, right? It would double in this case, which is not bad. Now, what if the stock goes down? Well, we've paid $1. We lose that dollar. The 149 calls are going to 0. And as far as our ratio structure is concerned, as long as we don't go lower than 131 by Friday, we make a 1-to-1 gain on the 140 puts. The fact that we paid $247 debit for it doesn't really matter because we really only paid $1 for it, right? Because it would be the net effect, okay? So that's another way to look at it. I like to think that this is potentially one of the better ways to look at it would be the ratio spread to the downside, maybe a butterfly to the downside, and an out-of-the-money call. All right, now before we wrap this up, what are some of the other ways you could potentially do on the call side? You could opt to take in a little bit less credit and sell it as a vertical, which would be like 140, 145. Thereby, if there was a huge gap up in the stock, you might actually make a little bit of money. And also what's nice about that is, let's say you are somewhere in between the vertical, 140 and 145 after earnings, all the IV is going to kind of crush out of it. You may actually be able to get out of that vertical for not too much of a ding. You might be able to actually get out of it close to what you paid, because remember, you've got this long 145 call in your favor. So let's say stock gaps up small, opens up at say 144. Obviously that 140 is $4 in the money, and you're going to be losing on that, but that 145 is going to blow up big for you, right? Because you purchased it at a much lower price. So you're probably going to be able to get out of that spread for, I would say, less than $3 probably, especially on the day right after earnings. There'll still be a lot of implied volatility pumped up. So you could think of it that way. And what else? Let's see, this one does not apply. That's about it. I'll leave it there. I'll say, vertical on the upside is one way that you could look at it. You don't want to obviously do anything on the upside that would be like a ratio spread or anything where you have unlimited risk on the upside, because obviously you don't know how high it could gap. Now, a stock like Apple, I tend to think it could gap upwards a lot more powerful than it will gap downwards. Obviously, I have no way of knowing that. But, it could go to the moon on you, and then you're kind of screwed. So obviously you do not want to put on any structure on the call side where you're trying to sell extra calls in order to bring in a larger and larger credit, in order to, to effectuate what you're buying on the put side. So those are some ideas that you can use, and I hope I'm just kind of, sparking ideas in you all, and as opposed to telling you exactly what you should do. Because remember, everybody's situation is different. Everybody's basis in stocks is different. Everybody's risk tolerance is different. Many people would never put on a ratio spread ahead of earnings with such, maximum downside risk, things like that. So take what I'm showing you and take it as sort of just a starting point, as a springboard to your own creativity to sort of think outside the box and see where you can place different spreads all around wherever Apple is trading. And remember, you may come to a decision on your own that maybe you don't need full protection. Maybe you're willing to give up some gain in order for that hedge to be very cheap. So instead of a long put somewhere at the 140, you may start your long put lower, which is going to make the cost of the hedge a lot cheaper. And in doing so, you'd be willing to, you'd be selling a call way up here. You might be able to even sell the 150 call to pay for it, or something like that, like a really high call that has very, very high odds of completely going out worthless, right? So just be creative with it. Adhere to your own standards of risk and what you're comfortable with. But again, think of all this stuff as like a springboard to your creativity, as I was saying. And it's all really just kind of to get you thinking and give you some ideas on how you can look at things ahead of earnings. And last but not least, I thought we'd end on Bitcoin. Not something that we talk about all that often, but I've done some Bitcoin trades recently, both in the futures, which I showed on Twitter, and also in the stock called Riot, R-I-O-T, which is a Bitcoin mining company. And I just want to point out one thing that's important. This is something that I talked about on that Benzinga Zinger Nation Power Hour earlier this week. The link to that video is at the end of this video if you missed that presentation. But what I talked about in that presentation on their show was the fact that we broke the uptrend right here. Now, we have not broken the main uptrend, which would be from here. But honestly, going to there puts BTC all the way down to about 24,000 currently. And obviously this line is going to move up the point I want to make here, I don't want to spend too much time on this, is just the fact that please understand that for a longer term perspective, Bitcoin will not be in an uptrend until it crosses this line. So it is now in a downtrend in the short term. And another uptrend will not start until you can get back over 32,000, 33,000, 34,000. Just keep that in mind. I also know, obviously it's pretty obvious, you don't need me to tell you this, but that it is extremely volatile, and you will probably have a lot of very choppy action between now and then when it decides whether or not it's going to break that trend line to the upside, or if it's going to go sideways and it's going to kind of stay weak, and we're going to have the main trend line at some point, I should say, come into play. All right. And if you're looking at these BTC futures, be very careful with them. They are not for the faint of heart. They also not for newer traders, and they are definitely not for those of you who have smaller accounts, because they are $99,000 of margin for one contract. So just think about that for a second. One contract, and every point that you see here is $5. Okay, it's $5 for every single point, because Bitcoin trades in $5 increments or tick size, and that $5 tick is worth $25. So obviously if you divide it down to 1 point, Bitcoin is actually $5 for every point that it moves on these BTC futures. So again, not for the faint of heart. You may be more interested in GBTC. If you're looking to speculate in this stuff, that may be more to your liking, which is an ETF that tracks the price. And then also, as I said, Riot is an interesting stock as well. All right, so just wanted to point that out about the trendline break. I thought it was kind of a big deal because I really thought it was going to hold the trendline break. I actually documented a trade on Twitter. If you want to check it out, my Twitter handle is right there on the screen. I documented 2 BTC trades in the last week or so. The first one was a huge winner, and the second one was break even, because I had a limit order sitting at the pullback low where it should have, and it obviously broke it, so I had to scramble and buy another contract near the low of that day, and on a rally, on a subsequent rally, I should say. You don't see it here in the daily chart. You can see it only on an intraday chart, because it was in here. Or whenever I was able to break even. But, you know, I think I did the right thing, because Bitcoin actually went lower after that. And I think the outlook right now is a bit cloudy, to say the least. So definitely be careful out there with the Bitcoin.